This video will be a stock analysis for a company called Conagra Brands. A lot of you know that I'm currently in university studying financial economics, and for one of my last classes that I have to take, which by the way, it's my last semester, so as long as I don't fail this class, I should be good to graduate. Anyways, in this class I was given a random company to analyze using the Chartered Financial Analyst Institute metrics. So I felt that if I had to do this for school, I may as well just make a video on it anyways, because I'm already interested in this kind of stuff.
I'm already doing it!
We'll be going over a business description of the company, their industry overview and competitive positioning, financial analysis, valuation, investment risks, and finally a conclusion. Should you buy it or not? So Conagra Brands was founded in 1919, but right now it currently has 16,500 employees and is located in Chicago, Illinois. You may not know the company itself, but I'm sure you might know them by their brands, which include Slim Jim, Hunt's, Vlasic, Orville Redenbaker's, Bird's Eye, Mary Callender's, Duncan Hines, and last but not least, Chef Boyardee.
Can I go eat a quick can of Chef Boyardee?
Oh, no time.
The company has a pretty good ESG rating, which is environmental, social, and governance, which is basically an indicator that tells investors and society how good the company is at functioning in society. Are they hurting society or are they helping it? This is a metric I like to use whenever I invest in a company because in a way you can use this to vote with your dollars. Ideally, it's good to support companies that benefit society and the environment. So for environmental, they plan to convert all plastic packaging into recyclables by 2025. The company so far has reduced plastic use by 2.1 million pounds since 2017, and their end goal is to avoid 33 million pounds of plastic in the future through innovation and packaging solutions. They have a mandate to make safe, delicious, nutritious, convenient food while addressing impacts linked to their products. On the nutritious side of things, that's kind of debatable because I don't know how good canned spaghetti is for you.
Boyardee, spaghetti in a can. It's so mushy.
Conagra Brands has 5 main competitors: McCormick & Co., Tyson Foods, Kellogg, Campbell Soup, and J.M. Schmuckers. Analysts have predicted that the global consumer packaged food sector will be stable in 2021, and there's even a chance it could grow. For 2020, Moody's, which is a rating agency for financial companies, estimated that the profit growth for this industry would be 3 to 5%, and the average industry operating growth is 3.71%, which is pretty on line with the estimate. For the fiscal year end May 31st, 2020, Conagra Brands' operating profit margin growth outpaced the total industry with an increase of 5.38%. However, a lot of that probably has to do with the spike in sales that they experienced from coronavirus. When the COVID lockdowns happened, a lot of people had to switch from eating out to eating at home. And because of that, they would go to Walmart and buy prepackaged food like the types that Conagra Brands offers, and that dramatically boosted Conagra Brands sales. Keep in mind that in 2019, Conagra Brand had a decline of -5% in margin growth, which means this year's growth was really just making up ground that they'd lost previously. The company obviously has a large portfolio of leading brands, and it's an important retail partner to companies like Walmart. They've had consistent growth from operations, but their margins have been pretty stagnant or not growing for the past 5 years, which means that the company could potentially be struggling with pricing power. The majority of the company's products are highly processed. If you think about Slim Jims or Chef Boyardee or whatever it may be, all of these are food goods that have a lot of kind of artificial processing that goes into them. And there's actually been a lot of recent studies that show that consumers are willing to pay more for higher quality organic food.
Organic ice cream.
We've even seen a huge explosion in the plant-based meat industry with companies like Beyond Meat gaining so much attention over the past few years. I read through their recent financial statements, and the company is selling off brands that are not performing well, like their Lender's Bagel business, and they are harvesting those for cash in order to redeploy that into the brands that are already doing well, or with the attempt of buying a new brand, potentially that will be on trend with consumers. From a competitive positioning standpoint, one other thing that I did notice is that the company is underinvesting in research and development, where only 0.5% of their total revenues are going into R&D, where their competitors maybe 2 or 3% of their revenue is going into R&D. Moving on to financial analysis, I picked a few key financial ratios that I felt were most important for Conagra Brands when compared to its competitors. This is a graph of the company's revenue growth with the fiscal year end of May 31st. As you can see, from 2014 to 2017, the company's actually had a decline in revenue growth, and they've really only increased revenue growth from 2018 to 2020. And a large part of that was due to the COVID-19 pandemic, when everything was locked down and people had to eat at home. Their gross margin is 28% compared to the competitive average of 31%. It is important to note that they have significantly smaller margins compared to all of their competitors except for Tyson Foods, but Tyson Foods focuses mostly on processing meat, I believe, and so it's kind of hard to make a direct comparison there. The debt to equity ratio is actually pretty good compared to the competitive average. Debt to equity ratios indicate the relative proportion of shareholders' equity and debt used to finance the company's assets. So basically, it's just how much debt do they have compared to equity. And that is kind of, you could think that's kind of high, but in reality, it's kind of seems to be industry standard to have a large amount of debt compared to equity. From a price to earnings standpoint, the company actually looks relatively cheap compared to the competition at 15.23%. The PE ratio is basically a ratio of the company's share price to the earnings per share. So in this case, you're basically paying 15 times their earnings that they actually make based on the value of the company. From a price to book perspective, the company actually does very well compared to competitors. Price to book is pretty much how expensive is the company compared to the value of the underlying assets on its balance sheet. So there's many different ways to value a company. You could use the Gordon growth model or dividend discount model. You could also use other things like a leveraged buyout model or a DCF, which is a discounted cash flow. In this case, I did do a DCF model.
And I wrapped our financials. I did a DCF valuation.
A DCF model is a forecast of the company's future cash flows discounted back to the present day. And if the future cash flows equity valuation is higher than the current market valuation of the company, which is what you can buy it for on the stock exchange, then potentially that can mean that the company is worthwhile to look into. I will preface this with saying that there are a lot of people who are much better at DCF analyses than me, and it's something that I don't have a ton of experience with. Having said that, I looked up about 20 analyst price targets for this company, and it was from the $36 to $39 range. And I came pretty much right in the middle of that at $37.38. Now, I did do this valuation on November 18th, which was actually a couple weeks ago. So there could have been some things that changed, but I did look into the company before making this video again, which I'm filming this on December 6th, and I haven't really noticed anything that would have changed my valuation metrics. When I valued the company November 18th, the stock was trading at $35.48, and December 6th, the stock is trading at $35.49, which is actually pretty good because it's gone up and down a lot, but it hasn't really changed. You might say, Adam, you're predicting the future cash flows to give it a value of around $37, and if the current value of the stock is $35, why don't you just buy it right now? There are risks that come with every investment. The first risk is a shift in consumer taste and preferences. Yes, right now, many people may still be okay with buying highly processed food because, hey, if you're locked down at home and you don't really want to make a meal, Conagra Brands products might be the way to go. There's plenty of research to suggest that consumers are shifting away from processed foods and are more interested in buying things that are organic and healthy.
Hey, is that healthy food?
The company also has a lot of competition. In my financial analysis, I only compared Conagra Brands to 5 competitors, but in reality, Conagra Brands has over 100 competitors. These companies have different sizes and different growth expectations, and over time, they may compete with Conagra Brands to the point where they take away a large percentage of their market share. The third and most significant risk I found was pricing power. Conagra Brands simply just does not have pricing power to increase their margins, and we can see that from their stagnant margin growth over the past 5 to 10 years. On top of that, over half of Conagra Brands' cost of goods sold relies on commodities. And if inflation rises, which inflation will impact commodities, which could be soy or wheat or meat or whatever they use as the input of their goods, Conagra Brands might not be able to justify price increases to cover that rise in cost. The fourth risk was acquisitions. Right now, Conagra Brands is underinvesting in research and development, and they are basically banking on using cash to buy brands that are on trend with consumers. In 2018, Conagra Brands bought Pinnacle Foods for around $11 billion, which is a lot of money.
Wow, that's a lot of money.
The reason why companies buy other companies is because they can grow from the acquisition. If Conagra Brands built brands internally by investing in itself, maybe they could build some brands that are really popular with consumers for a much cheaper price. So in the long run, Conagra Brands isn't really doing that, and they'll have to rely on buying other companies in order to grow. I don't really see this as a good strategy. Yes, growing through acquisitions is definitely something that every business should do, but at the end of the day, it's expensive, and there's a risk that comes with every acquisition, because sometimes it doesn't work out the way the company thought it would. The last risk is revenue diversification.
Diversification.
About 25% of the company's total revenue is directly from Walmart. Imagine if Walmart all of a sudden decided to change the types of partners it works with. Maybe they'll start favoring companies that offer more organic and healthy foods, because that's what their customers demand. Well, Conagra Brands might be out of luck in that case, and they would lose about a quarter of their total revenue. And let me tell you, that would definitely impact their stock price. In conclusion, I didn't really see an economic moat for this company. There's really no barriers to entry. You and I could tomorrow start our own food brand and compete with Conagra Brands. That might not be as much of a problem if Conagra Brands had the pricing power like companies like Apple do, where they can charge a high price because they know consumers will pay for it.
Shut up and take my money!
The company does not really have that, and I don't see that in their margins. My target price for the company is around $37.78, which is about a 6.8% upside. In many ways, Conagra Brands could just simply perform similarly to the S&P 500. But what are the downside? The downside for the S&P 500 is a lot less because it's a basket of the 500 top companies in the United States. Conagra Brands is just one company, and I see a much higher downside risk for Conagra Brands than I do for the S&P 500. Finally, from a margin of safety perspective, the market right now is pretty expensive. Conagra Brands is arguably cheaper than its competitors, but is the price that you buy it for really going to protect you in the long run? It's hard to say. I personally feel that there are a lot better options out there for companies that you could buy that could offer better protection. Please leave a like and subscribe. Only about 20% of the people who watch my videos are actually subscribed, so if you could please subscribe, that would really help your boy out. Thank you very much, and have a great day.